Thanks everyone for attending today's webinar, New Models Driving Improved Efficiency in Commercial, Industrial, and Small Utility Markets, brought to you by Panasonic in conjunction with Solar Power World magazine. We would like to thank Jamie Evans, Managing Director and Head of U.S. Eco Solutions for Panasonic Eco Solutions North America, Jonathan Jaffrey, CEO and Managing Director of Coronal Management, and Edwin Fio, COO and Managing Director of Coronal Management, for giving us their time and insights into this timely topic. I'm Frank Andorka, Editorial Director of Solar Power World, and I'll be your moderator today. Just a couple of housekeeping details before we get started. If you wish to tweet about this webinar at any time during or after, you can use the hashtag SolarWebinar. We love social media, and we hope you do too. You can follow us at SolarPowerWorld or me at SolarFrankA. We will have a Q&A session after the presentation. You can go ahead and submit your questions using the GoToWebinar on your screen, and we will ask them after all the presenters are finished. So without further ado, I will hand the mic over to Jamie Evans, Managing Director at Panasonic. Jamie?
Thank you, Frank. I'm joined here by Jonathan and Ed. I think we have a few slides we'd like to go through that focus on some of the issues we're seeing in the commercial and small utility solar PV markets right now. I will touch on current market conditions, and then Jonathan and Ed will focus on some of the inefficiencies that we see and some of the resolutions and new models that we and others are working on to bring more efficiency to these markets. As I'm sure most people are aware, we have seen system prices fall dramatically, certainly over the past 10 or 12 years, but even more so over the past 2 or 3, driven mostly by steep declines in module pricing, as well as some other system components. This certainly makes it easier to get systems built, makes the financing a bit more easy to pull together in terms of hitting investor returns, but overall I think this has been certainly a positive trend for the market. There seems to be some stabilization of module prices that we've seen, but we expect the installation prices and construction prices to continue on a downward trend, perhaps not as steeply as we've seen over the past couple of years going forward. The market certainly remains regionalized and fragmented. Thinking about commercial and small utility projects that for us is anything in sort of the 1 megawatt up to 20 or 30 megawatt range. Still very state specific. California is still well in the lead in that context, but other states certainly becoming more active. Some of the ones that we've shown on the list here, we're actively looking at projects in a number of these states. I think the non-residential segment now topping a gigawatt a year or so ago was a nice mark to hit, and the financing models that we will talk about later I think are increasingly important as people continue to run through safe harbor equipment and cash grant deals and return to proper tax credit deals. We will see, I think, an emergence of more innovative financing vehicles driven specifically for this part of the market. The residential segment I think has seen some efficiency in the models that they've put together, and utility scale projects continue to be one-off project finance assignments for the most part, but in this commercial part of the market is where I think the financing has been the most difficult historically, and where we're seeing some new developments right now. terms of the market forecasts, this is not new data for a lot of people, but capacity is still estimated to break through 10 gigawatts by 2016 in the U.S., and this is for residential, non-residential, and commercial scale. So that growth curve continues in a positive direction. And then looking specifically at the market segments, the non-residential sector, where we spend the most of our time, is projected to grow through the end of 2016 up to about a third of the market for maybe a quarter or so today. So that's just a brief snapshot of some of the things we're seeing at a higher level in the market. And now I'll ask Jonathan to address some of the hurdles and challenges that are specific to this commercial and small utility segment.
Thank you, Jamie. So as Jamie said earlier, the market is segmented between utility, residential, and commercial. And what we'll spend most of our time on today is really that center segment. The residential sector, as we know, has begun to mature. There are a number of financing vehicles that have solved the issues that were facing those systems, from home leases to power purchase agreements and outright ownership, that's become more attractive. And likewise, the larger utility scale programs fit well with traditional types of project financing. But as we look to the middle and we look to the commercial customer, the smaller municipal systems, and even some of the smaller utility systems, we find it a different set of circumstances. So we look at these customers as the largest users of electrical power outside of the utilities. They're typically focused on something else, whatever their core business is, whether it be commercial or a municipal utility, government unit, education, or otherwise. So worrying about solar and how their project is being built and operated is not a primary concern for them. So they're looking for turnkey projects with trusted partners. And I can't say enough about trusted partners in the fact that these are going to be 20-plus year relationships as we look at the terms of these financing agreements and the expected life of the equipment. It's something that all entities struggle with in their own life cycle and making decisions over that period of time. As we're seeing across the country, utility costs continue to rise. While unpredictable, it's certainly a lumpy kind of movement. Some years not seeing much, and others seeing large increases, and without consistency across geographic areas either, either affected by aging infrastructure or options for base power. You can look across the board, though, and see that utility costs in this sector are continuing to rise, making renewable energy an attractive alternative. Once a customer is focused on that, then they're really getting back to this reliability and development and implementation focus, and that's where we'll spend some of our time today. What we're seeing is that while that was the big driver, rising costs and how to address them in the past, we're also now starting to see more interest from customers taking in the non-financial benefits and the sustainable initiatives. As you walk into buildings, you're seeing markings for green other than just LEED buildings, different types of associations, and businesses are beginning to value the non-financial side of sustainable energy and taking it into account as they move forward. So in summary, from a customer standpoint, there's a large underserved market that falls in between that large utility scale and residential customer, where there is no one-fits-all solution. So let's talk a little bit about the common issues to that market. So first is a void in project financing. Unlike the residential and utility scale markets, there isn't a single vehicle. And as Jamie said earlier, A lot of the growth over the last 3 to 4 years has been driven by the Treasury grant program making financing accessible at all levels, whether you are a small developer or EPC or large. There was an equal footing. And the expiration of that program returns us now to a much more complex structure seen in sale-leasebacks and flips and other modifications of those structures that not only require complexity in structuring but expense in putting them together, and typically size and scale in the entities involved with it as we look at liabilities and indemnities and putting together those processes. The flip side of that is really the customer lack of familiarity with that process. Big or small, customers understand procurement. They're used to buying things and paying for them. What they're not used to is these complex ownership structures. Rather than going out and buying a fleet of vehicles and doing a lease, they're now all of a sudden involved with somebody who's going to use the tax benefits because they're not, and you end up with not only a much more complex ownership structure, but sometimes partners you never contemplated having in tax equity partners and the like. Add that to a lack of familiarity with the service providers, being that many geographic locations there is no leader. You're being called on by a dozen different players, and decisions on who to work with are sometimes made more on relationships than they are on market leaders in the industry. You have both a complex ownership structure and an unknown service provider in contemplating a 20-year asset agreement, which for many makes the choice that of procrastination or stagnation and not making any choice at all. The economic expectations in this market segment are also, I think, in this current time, somewhat challenging. In coming off of the grant program, there were opportunities for financing at lower costs that aren't available today, and I don't think that's permeated the market yet, making that sales process even more difficult on top of the other items that we've talked about. And finally is the system long-term maintenance and performance. For many, figuring out what a system will perform over 20 years and how that's going to relate to some estimation of rising energy rates and the like make this a very complex financial decision. Somebody has to have a view on what their energy costs are going to increase, what the cost of maintenance are going to be over that period of time, and then the physical asset itself, what will it continue to produce, how will it degrade, can it be maintained. Again, just adds tremendous amount of complexity to the situation. So I think the task, and I'm going to turn it over to Ed now to talk a little bit about how to solve some of that, is really how to reduce the complexity, how to give more comfort to a customer, both in the structuring and the long-term performance of the system, and bring it down to something that they can understand. Ed?
Jonathan, thanks very much. Let's go to the next slide, which really the key here, as alluded to, is streamlining the process of origination, installation, financing, and long-term operation of these assets. And from a customer point of view, we think what needs to be done is to simplify the story and the process, and this is in terms of the transaction dynamics. There's a limited number of people they have to deal with, and they're trusted participants in terms of the finance structure, and finally, in connection with the system installation and long-term performance. Our approach in the Panasonic Coronal partnership is to propose to customers essentially one source, one contact for the installation and operation of the assets long-term, backed up by a large balance sheet company offering a 20-year performance guarantee. From the customer's perspective, what they're seeing is a non-finance contingent offering, one that is not dependent upon the vagaries of equipment supply or performance from a number of different vendors, but looking at, say, a single point or single company that is backing up the install and the performance of their system. Another step that we're taking is in coming up with cleaner transaction structures. And what this really means is a couple of things. One is to develop and utilize standardized documentation and processes in terms of transaction evaluation and review and execution. It requires an investment up front in those processes and documentation, but it's effectively to have something which is, once the investment is made, is eminently replicatable across a number of transactions. It's also, in terms of transaction complexities, at least our approach has been to have a relatively simple financial structure which is not dependent on the performance of multiple parties, at least from the customer's perspective, so that they can look at it as simply a single point, low risk of transaction execution situation. When we talk about more efficient documentation process, I mean, part of this is the standardization of documents. Part of it is to have effectively a means of having come down the middle of the fairway in terms of the approach to what the customer is looking for, and to have the optionality of those documents be focused on things which should matter to the customer in terms of size, price, tenor, those sorts of things, but otherwise minimizing customization. And in our documentation processes, as one might expect from a large corporation, there's a fair amount of not just standardization, but also digitization of process to be able to drive volume with a minimum number of hands handling the transactions. Another aspect where we think we've streamlined the process is through the integration of construction and permanent financing. We're able to offer, again, at a single point, 100% financing from construction through the life of the asset. There is no finance contingency. There is no, I need to go find tax equity to close a deal. All of that has been solved up front and essentially exists behind the screen from the customer's perspective. Another aspect that we talk about is what we call our trusted construction and O&M partners. And really there's two aspects to this. It's development, and then procurement and provision of services. The approach we've taken is an open architecture approach on the development side. We see the development community as being one which is fairly well addressed by current participants with the skill sets and knowledge which is relevant to the particular markets in which they're located. We're not developers. We seek to be essentially the financial and other infrastructure that's available to our developer partners. And so in that respect, they're able to participate in our process and receive what we think is a very fair value for their efforts in the development effort and get the benefit of the procurement, installation, financing, and long-term operation support that this program offers. On the vendor side, one of the strengths of the Panasonic brings to the venture is the strength of procurement that comes from nearly 100 years of being a manufacturing firm. And in that respect, their quality control and engineering processes are world-class, as is their procurement policy, which effectively drives high volume through a limited number of highly qualified vendors, with the result that great product is obtained at a low price, and that adds value to the transaction, which is there for the benefit of all the participants. So where do we think this all goes? We believe that this industry, and in particular, it's in the segment that's really in the C&I space, is going to go through consolidation. It's a function of, among other things, some of the financial events and circumstances that Jonathan described, not the least of which is the sunset of the grant program and the reemergence of a fairly complicated, sticky, and in some cases fairly sponsor-driven capital allocation process that takes place with tax equity, sponsor equity, and debt. And the other is that as we move forward and there's consolidation on the manufacturing side of the business, that we believe there's greater benefit to be achieved both in terms of timeliness of supply as well as price of supply of equipment that has not been available in the market to date. And that, in our view, will be part of what will drive consolidation as smaller players have difficulty in obtaining both capital and equipment on a competitive basis. So when we go to the next slide and we talk about anticipated results, our objectives are, and we believe these can be achieved, is to achieve lower customer acquisition costs. It's just to essentially have a marketing program and also sort of the soup to nuts procurement program that drives a lot of customer acquisition costs out of the system. Second, in transaction costs, we've invested a significant amount up front for the purpose of establishing a system in terms of capital, in terms of policies, in terms of procedures and documentation. The incremental cost per unit is quite small by comparison to that, and that makes each transaction cheaper. Third, which is not mentioned here, but I think it is important to note again, is procurement. Again, utilizing the skills and balance sheet of a global company, global technology company, to enhance the procurement process and drive efficiency. Fourth, implementation velocity. What really makes sense in this business, in our view, is that transactions are sort of less customized and less bejeweled little deals, and much more of a market product that can be transacted on quickly. And we think the speed at which projects can be implemented will make them more cost-effective. More cost-effectiveness effectively will drive more velocity. Next, when we talk about greater capital deployment, our platform, really is designed to implement a very significant volume across a bunch of relatively small assets. And if you try to deploy the capital across those individual assets, the difficulty is that most investors and lenders are not interested in working on smaller transactions, and the result is that there's essentially a capital constraint or an increased cost as a result. We think that having a vehicle which consolidates the financing and the investment through one place will result in greater capital deployment at a lower cost. And all of the foregoing then results in the last bullet on the slide, which is that we think that results in higher margins for the participants and what we think will be the successful participants in the market. So we go, Jamie, do you want to come back to, you'll come back and talk about Panasonic and Coronal, which I think is the next slide.
Yeah, thanks, Ed. So just to tie together the Panasonic and Coronal teams and how we're looking at this market. From Panasonic's standpoint, we are focused primarily on the engineering, the project implementation, the procurement that Ed mentioned, providing construction period financing, and then stepping into a long-term operation and maintenance obligation for systems that includes a production guarantee on the back end that is ultimately backed by a $55 billion global balance sheet. We have a relatively open architecture in terms of who we work with and who we partner with, and in terms of diligence and looking at opportunities in this commercial and small utility space. We're bringing the engineering and procurement expertise of the team here in North America, as well as some of our global resources on the technical side to focus on that side of the transaction. Coronal, our captive financing partner, brings really an institutional scale financing and asset management model for systems that are built and maintained by Panasonic. And we think that the combination of the two organizations has allowed large institutional investors who historically may have shied away from this sort of middle market to get involved and to start to deploy capital, because they can see a path where they're not looking and working through one individual 5 megawatt project and all the transaction costs and inefficiencies that are there, but can instead deploy a meaningful amount of capital into a portfolio of assets, all built and operated by Panasonic with very similar documentation structures that allows diversification in that portfolio from a geographic perspective, from a credit perspective, that we have found is attractive to the investment community, whether those investors are in the equity, debt, or tax equity pieces of the capital structure. So our combined team is looking to bring this end-to-end solution, end-to-end platform that we feel is largely absent in the commercial and small utility market today, but being able to go both to customers as well as investors and offer a much more efficient, much more simplified process from sales support and development through construction, financing, and then back-end operations and maintenance that is all backed by a large global organization and is supported day-to-day by a team of professionals, both on the Panasonic and Coronal teams who can manage that entire process start to finish. We continue to feel that there's tremendous opportunity and upside in this part of the market. It remains fragmented, largely underserved, but for those groups and organizations who can drive toward this type of more efficient model through development, build-out, financing, we see a lot of upside in this part of the market. So I think with that, we're happy to address any questions related specifically to the slides or other topics that people are interested in discussing.
Thanks so much. I'd like to thank Jamie, Jonathan, and Ed for their presentations on all the new models that are driving improved efficiency in the commercial, industrial, and small utility markets. We will now open the remaining time for questions.
One participant asked, what is the definition of third-party financing?
So, as a customer, as an organization that is interested in deploying solar assets on their facilities, and in this market that could be a corporate partner, a municipality, a college or university, you essentially have two options. You can either self-finance the system, which means you buy it, you make a CapEx commitment to purchase and own the system, or you arrange for a third-party financing solution that is what we typically offer through our platform, that would take the form either of a power purchase agreement or a lease, whereby the customer would neither make that upfront CapEx commitment, nor would they own the asset going forward. They would make a long-term commitment either to simply purchase the power that comes off of the system or lease the system from a third-party owner.
Thanks. To what level is social financing, tax credits, breaks, taxpayer support, will the future growth of solar be dependent on?
It's a good question. I think the fact that it's available today is what drives the structures that we see in the market. The current ITC program is to sunset at the end of 2016, and if that program is not renewed, there'll be very little in the way of tax incentives generating financing models going forward. What we'll have left is the normal depreciable benefits that we see in any kind of asset purchase. So as that happens, we'll see simpler models for financing. We'll probably see, because of the long-term nature of solar, like any other asset building or otherwise, debt playing a much larger role in how these structures are put together and the cost that results from it. And as the market for debt matures in this segment, in this sector, I think we'll see probably improved pricing for the customer, improved profitability for the investor, and transaction costs being significantly less because you won't have the complexity not only in the structural documents, but the third-party ownership will no longer be necessary as well. So I think we could see a double benefit, quite frankly, after the expiration of the current tax structures.
I think what I would add to that is in addition, we may see the develop of longer, tenor maturities debt, which tends to, again, to help the economics. We've looked at this and think that indeed this business will do just fine after 2016 if the ITC steps down from 30% to 10%. The other aspect of having a broader debt market is that then is more product that's available to go to capital markets and achieve even greater cost reductions or lower cost of capital for what are either fully securitized or partially securitized assets. So it's, while there's a great deal of focus on the value of the investment tax credit today, there are definitely ways to get to cheaper capital in volume after 2016.
Let me follow up on that for a moment. We've heard from a lot of people that there will be a rush of projects ahead of 2016, as we did when the 1603 program went away. Is that how you see it?
Well, I think that there will be a rush in the sense that projects which have been designed with a particular return based on the tax benefits will seek to get done by the expiration date of the investment tax credit. What's different from the cash grant program is that the volume of tax equity that's available in the market is relatively finite compared to the resources of the federal government to write checks for cash grants. And so I think what will happen is that while there will be a sort of a movement of assets which might otherwise naturally have closed in 2017 into 2016, the governor on the volume is essentially going to be that there is a certain amount of tax equity available. It will get committed and frankly gets allocated not so much on price, but on allocation by, I'll say, sponsor relationship, size of assets, and perception of quality of assets. And that will, I'm afraid, leave a number of people shut out from getting tax equity deals done prior to the end of 2016.
What are the future expected returns on investment, and what is the definition in terms of percentage of ROI of higher margins?
That's an interesting question that I'm not sure there's a single answer to. Investor returns in the renewable sector, just like any other sector of the market, ebb and flow over time, based on a whole host of factors. The nice thing about, this sector is you've got a relatively, low risk investment from the standpoint of, what the system does, where it does it, and how it does it. That being said, it will react both beneficially and poorly, to interest rates, both now and as they become more dependent after 2016. From that perspective, so I don't think there's a single answer. I know a lot of people like to look for if my project just hits this, return, that's going to make it attractive. But I don't think it's that simple. Utility projects tend to trade at lower returns because the investment grade offtake and the lower risk associated with the useful life of the asset, as opposed to a more distributed generation-like project that at the end of the contract, it's questionable whether that asset will stay up on the roof, the owner of that building will pay for it at that point, and what the renegotiation of the power rate will be. So I think a lot of things go into it, and there's no simple answer. That being said, I think over the last couple of years, people are trying to put together financing packages and systems, that probably put out returns, maybe no less than 8 and into the low teens, depending on the risk factors involved with them.
What are the key challenges in third-party ownership of commercial and small utility projects?
Well, I think earlier we talked through a lot of the challenges, but I think the main overriding one for most people is you now have something attached to your building that you are dependent upon and working with that you don't own. And for most of us, that is a scenario that they're not either knowledgeable about or comfortable with. While leasing has become very popular in certain segments of the market, business equipment and automobiles and otherwise, that's usually a finite, I'm going to have this copier in my office for the next 2 years, I know what I'm going to do with it, and in many cases, being done for operations and maintenance perspective. But the thought of, a 20-year piece of equipment that you're involved with some third-party owner that not only might you not know on day one, but could change hands multiple times over the 20-year period, brings an increased level of uncertainty and therefore uncomfortableness.
And Jonathan spoke about that, the third-party financing issue from the customer standpoint, and some of the things that customers need to get comfortable with. The other side of that, in terms of challenges with third-party financing in this part of the market, is arranging the capital, at large scale. I think most of the institutional investors that have deployed meaningful amounts of capital into the solar market have done so either at the residential level, where they can see a process-driven model that leads to thousands of installations per month, and they can do the analysis around that, or they would look at one-off large utility scale opportunities, and they have had some concerns around the commercial part of the market, and some of which we've talked about in terms of the documentation process for a one-off 5 megawatt deal, and where does the construction finance come from, and who's the balance sheet behind the O&M on the back end, and where does the pipeline come from in terms of recurring business. And if I'm a bank or an investor, why do I want to commit the time and resources to deploy capital into this part of the market where, historically you could make the argument it might be easier to do so at the residential or utility scale, but I think it will be the groups that can overcome some of those hurdles in terms of attracting the institutional investment community that will really drive the growth for market participants in the commercial sector, but also bring some of that efficiency and simplicity to the client side of the equation as well.
Jamie, this one's for you. Are these systems going to use specifically the Panasonic HIT modules? And does Panasonic see a future of becoming a vertically integrated supplier?
So the systems that our team designs and implements do not have to use the HIT product series. That product is typically more appropriate for residential scale applications. We do have 900 megawatts of global manufacturing capability. We just opened recently a new facility in Malaysia. We have a robust module sale and distribution business in our home Japanese market. But our particular model that we have in place with Coronal does not necessitate that we use our HIT panels. Our engineering team then, when we look to partner or work with other third-party module suppliers, there is obviously a robust, technical review and quality control analysis that occurs globally with some of these groups to make sure that our team is fully comfortable with third-party electrical components that are going into these systems relative to the operations and maintenance and production guarantee obligations that we have on the back end.
How would third-party ownership, or how does third-party ownership work in states that don't allow third-party PPAs or solar leases?
Is that a trick question?
I guess the short answer is it doesn't. If PPAs or leases are prohibited in certain markets, then the third-party financing model would not be viable, and we would speak to those customers more in a direct sale, cash purchase scenario.
I guess that's right, and the only wrinkle is that in those markets you don't have third-party ownership model, but you can still have, and there is financing available with respect to owner-owned systems, as in just loans in respect to those systems. It's not tax efficient.
From an installer's perspective, how do they partner with you guys? And once a customer has been qualified, when does the partnership come into play?
That's a great question. The Panasonic Coronal platform is an open platform, so we are always looking to partner with new developers, EPCs, and other service providers. I think that the earlier that relationship is established, the better it is for the partnership and for the end customer. So we're happy to get involved in a conceptual phase of the project as it's developed for a customer, whether commercial or utility, and that we're able to influence at that point what would be a mutually beneficial situation for the customer, in partnering with whatever service provider or developer has the project. And I believe each of Jamie, myself, and Ed's contact information is up on the screen. And if anybody's got any specific questions about how they might work with our group or how we can help them, any of us would be happy to take that question.
If you have any additional questions for Jamie, Jonathan, or Ed, you can send your questions to me at fandorka@solarpowerworldonline.com, and I will pass them along. Thanks everyone for attending this webinar from Panasonic in conjunction with Solar Power World. Please look for this presentation in your inbox because we're going to email it to you tomorrow. It will also be available permanently at www.solarpowerworldonline.com.